Your DTI is your monthly finance debts plus your future mortgage payment divided by your income before taxes. So when I say monthly finance debts, that's stuff that's on your credit report, stuff that you had to get your credit pulled to get financing for. We're talking about a car payment. We're talking about minimum credit card payments. We're talking about student loans, even if they're in deferment. So we're not talking about phone bills and stuff like that. For your future mortgage payment, simply take what your rent currently is. If you're comfortable with your current rent payment, that is your future mortgage payment. Then work backwards to figure out what that equates for as far as a home price. Let's say you're paying $2,000 a month of rent, but you're like, hey, that's pretty tight for me. I'd rather pay closer to $1,700. Well, now to use $1,700, the other side of the coin is, you're like, hey, I'm living well below my means in order to save for a down payment. I'm paying $2,000, but I could pay $2,500 and still live a comfortable lifestyle. Well, now $2,500 is what you use for your future mortgage payment. Now, how do you figure out what that equates to as far as an actual mortgage payment? Well, that's another lesson. Check the video out right there. Income is where this can get a little bit tricky. If you're a straight W-2 employee, for instance, you make $60,000 a year, which means you make $5,000 a month as your base salary. Well, $5,000 is that number before taxes. However, if you get any sort of non-base income, we're talking about overtime, we're talking bonuses, we're talking car allowance, typically you'll need a 2-year history of those, and actually your underwriter will actually average that out over 2 years. For instance, if you have a $10,000 bonus year 1 and a $15,000 bonus year 2, your bonus will be $12,500. On the other side of the coin, if you had a $15,000 bonus year 1 and a $10,000 bonus year 2, your lender most likely will just use the lower number, $10,000. Now, if you're self-employed, definitely just talk to a lender. You make a lot less than you think you make because your CPA's goal is to write off everything under the sun, and your lender cannot use the stuff that has been written off. For more tips, go around here or somewhere over there.